Hey everyone, welcome back. It is May 6th. Sorry about my delay today. I literally was trying to chase down Purelator this morning, and shame on you, Purelator, for being so terrible. I'm out in my workshop. I'm like working away at my workbench. Garage doors open. Both of my garage doors open. Plain as day. Purelator comes up, rings my doorbell, which I don't hear because I'm in the garage. And then leaves a slip and leaves. So I'm like trying to chase him down to get my splitter that I've been waiting weeks to get, and it finally gets supposedly delivered to me 15 minutes before the stream. I'm like, let's go. This would be amazing. I could rip open the box, plug it in, and go. Instead, I'm chasing him down. I can't end up getting him, racing around the neighborhood like a madman. Anyway, super frustrated. Let's fingers crossed this actually works today because it's been intermittent at best. Hope you guys are having a slightly better day than I am. The one thing that is super great about today is that my sign is green. And if you know what that means, it means that I'm making money. When I woke up this morning, the market is down. We're going to go over that. We're going to take a look. But as an options trader, I have the ability to make money in any market. I can make money when the market's going down. I can make money when the market stays the same, and I can make money when the market goes up. I can adjust my deltas. It's the directional effect of what I want to do. I can also make money from volatility expansion, and I can make money from theta decay. These are the three different ways that we can make money. Directionally correct, time decay, working to our advantage, and volatility contraction or expansion depending on. Yes, I am hoping for my screen as well. Thank you, Mike, and good afternoon, Kevin. Good to see you guys here. I see we've got 11 people on, 1 like so far. You guys are fantastic. Remember, anything we talk about here, not financial advice in any way, shape, or form. I'm going to try to keep this relatively quick today because I got a lot going on, and it's a beautiful sunny day, and I want to be outside and away from my office. The reason that I'm a trader is because I have been able to successfully navigate a market and make a portfolio big enough that I am able to sustain myself and say, you know what, I don't need to work every single day grinding it out because my account makes enough money for me to live off of. Let's get into what's going on in the market today. We're going to take a look at some of the direction. Let's push the button and pray. Hey, Jem, good to see you here. Look at that. It is working. Hallelujah. Fantastic. This is the SPY. Off to the right, we've got the SPX trading 5607 down 0.75%. NASDAQ futures trading 19,871 down 0.92%. Remember, S&P 500 and the NASDAQ are highly correlated because of the Magnificent Seven. There's 20% of the market correlated in just 7 stocks. So these have about a 92% correlation. So when one is down, the other is typically down. The Russell has 2,000 stocks that are very, very non-correlated. They are getting hurt today, down 1.22%. Now, you guys know, if you're a patron of mine, if you're not a patron, you should be. Jump over to patreon.com/drawbridgefinance. You can sign up for the free tier, or you can sign up for one of the paid tiers to get all of my trade alerts. But at least get on the newsletter so that you guys are getting those, insights when I'm releasing them. It's completely free to do that. So jump over to there, patreon.com/drawbridgefinance. Make sure you're doing that. And then you will see the results that are being posted in my Discord from my very, very frequent Russell trades, which I typically trade on IWM. Now, the reason I do that is because I can do these in extremely small fashion. If we were to look at some of the calendars that I put on, today I put one on for a debit of $104. So these are like extremely tiny, tiny trades if we want. I put one on earlier today for $68. So we don't need huge accounts to trade these types of things. And there's massive potential there. We could have returns 20, 40, 50, 60, 200% returns. I traded a closed one last week that was over a 200% return. And those details are there posted in my Discord, so you guys can check that out. We're US oil trading at $59.25. Oh, I've lost my arrow here. $59.25, up 3.68%, and gold screaming upwards, 3,400, up 2%. Silver coming up 2% as well today. Natural gas trading at 344. VIX is still elevated at 24.93, jumping around here a little bit. But VIX, so for premium selling options, we want this high VIX. It also means that we could see some dramatic movements in the market. Now let me look at SPY right here. What we have on this chart, we have a 200-day moving average. You can see the SPX or SPY, both the S&P 500, trading below the 200-day moving average at this point in time. Point of control is still relatively high, up at 605, with the stock, trading right now at 558. What do we have that at? 558. Why? Yeah, 558. 69. You can see that right here. And TradingView doesn't actually do a great job of showing where the price is. I don't love that so much. Stocks. Let's look at some of the stocks we have on the list today. We've got Amazon, ARK dropping down 48.61. I feel like this is in the lower portion of its range. Good time to be potentially picking up some shares. You see, I've got a directional channel drawn on here. So this is bullish momentum. Any time when we're trading down below this channel, I am picking up and adding to my position. Amazon trading at 185. Wow, where are we? We're near this point of control right now. If we see that, here we go. We're loading. Yeah. Trading right near its point of control right now. What else do we have? Chewy, boy, it's been coming upwards, 38 bucks. MicroStrategy, these are all Bitcoin stocks, so we've got exposure there, trading well above its moving average. And SoFi, I talked about this in one of my shorts that I released this week, trading in that mid-range. And when we're talking about specifically about stocks that we like to trade the wheel on, one of the reasons that SoFi is so popular is just because there's a ton of premium in there. And I mentioned in that short, if you were to put on a position, say at like $14, and then another one at $9, you've got an average price at $12. So even people that were trading when the stock was up here, trading short puts against a company like SoFi can be extremely lucrative. Earnings came out recently. We've seen the stock jump up, and we're hanging out where we are. What else do we have here? Tesla. Is there risk that Elon Musk is going to step down as CEO? Boy, he's got a lot of haters right now. I'm not one of them. Elon, has built that business up the way that he's done it. I'm totally happy with how he has performed, but there's definitely some downside potential to the market or to the stock price of Tesla. Not great earnings as of late. What else do we have? Mike said, I have a scenario for you. Been toying with the in-the-money covered calls. For example, Palantir buy the June 20 80 delta call, sell weekly 60 delta call, keep rolling until a certain profit or loss is reached. Thoughts? Yeah, let's pull it up. Let's take a look at some of those things. So let's look at Palantir. How long are you going out, Mike? What's the date for the June 20 80 delta call? Well, June 20 80 delta call I don't think is long enough, because June 20 is inside of the range of fast theta decay. So when we look at, if you were to look at IV, the estimated IV, oftentimes it's overestimated in that range greater than 30 days and up to around 100 days. That's when the implied volatility is overestimated, which means that the extrinsic value in the options premium is greatest between that range of 30 to 120 days. So when we are seeing decay, that is typically when we're seeing the theta decay take place. Now there's rapid decay, granted, there's rapid decay in the very, very short duration. So like on the weeklies, the problem is that the decay from the other longer term options is still there. So typically this is why people trade leaps. They go out a year, because if they go out a year, well, now you've got time for the theta on the long option to not contract, and the theta on the short duration options to really contract. So I don't love doing a setup that's quite that long. June 20th being, where are we? We're right around that 45-day mark. June 20th is 45 days. So we're right in the sweet spot for capturing, if we sold it, we're selling the most extrinsic value. And if we're buying it, we're buying the most extrinsic value. So is that Purelator driving by? I bet it was. I think it was. I'm not agitated about it at all. Okay, let's look at the Purelator, or sorry, Palantir. We're not getting distracted by Purelator today. Options in the money. I don't have the deltas on here. Let me just pull it up on my other screen here. Palantir. I've got my real account open, so I'm not going to show you guys that because we don't share that kind of information. 80 delta is the 90. 9250 is the 80 delta June 20th. So that would be buying, if we were to buy that, the 9250, let me just mark it here on the screen. We would be purchasing that and paying 1870. Now on the shorter duration, we would look at, say, May 16th, which is next week, and then we'll scroll down and then, you know, selling, what were you saying, Mike? What delta were you selling? 60 delta? Weekly 60? So on May 16th, which is 10 days away, the 60 delta, which I like doing that kind of thing, is 107. That's a big spread. So just from a point of view of, you've got $1,500 of risk, you've got $500 of credit being collected for selling the 107, and then we have purchasing $1,500 position for the June 20th 9250 strike. There's two factors in there. The distance here is big. Palantir is not that great. You know, it has been super bullish, but if we take a look at their numbers, you know, I'm not saying that it's not going to go down or that it is going to go down, but look at this fair value here on investing.com, $63. And, you know, it's trading at 108. There is like a 41% downside there. I am not sure if that's smart to get into that. I feel like I'm going to sneeze. I'm going to try not to. I'll kill my mic if I do, so you guys don't have to hear that. If I was going to trade Palantir, what would I do? I don't mind. I don't mind diagonals. I just think that I would keep it really, really tight. What I might do is I would trade a little bit further out than the 60 delta. So instead of trading like that 107 and collecting 565, what I might do is, what am I looking at here? Why? I might sell a little more aggressively. I might sell the 1030 here, the 100. What this does is it generates a little more income. The other thing I might do is I might consider loading these contracts up. So I have some sort of ratio in here. If I want to get long, I might play it as a calendar. I might say buy the 100s on June, sell the 100s on the May 16th contract. You get tons and tons of theta decay. Then if you want that long exposure, just get one more long than you are short. That'll give you that upside. I don't love this play in general, but if I was going to do it, I would be playing it with calendars, I think, rather than with poor man cover call setup, because I think the risk is just too large. If, you know, Palantir could just gap down to 75 bucks and then you're like at a full loss on that trade. And you know, I hate to take that much risk for relatively low returns on those setups. So, only entering the trade on stocks that have been beat up. I do like in the money covered calls completely. And I do like that setup where you're selling the 60 delta call that's in the money and then selling it. And then let me pull it up here. Palantir, May 16th. Let me just build the whole trade. So if we were doing the 107, which is I think the risk reward is just not that great, but I'll build it and then I'll show it to you. Let's see if this will work. it's fine on the big move, but the risk reward is not that fantastic. So I'll show you a trade that I like better than this. So that's the setup of the diagonal, the 60 weekly, and then the 80 80 delta on the June. What I would prefer if I wanted, say, that 60 delta is, yeah, I would just do it like this. I think this is a stronger trade. Here's the calendar. And the reason I like this calendar a bit better, oh, what are you doing there? Sorry, lost it there. Come on, really? Sorry, this is what, it's so much easier to do this on the thing. I am looking for a good, here's the calendar. So there's the calendar, and what this is this is the May and then June, just the 105 calendar. The reason I like this is because look at that profit potential. You've got up to $400 profit, and you've got only like $350 risk on it. So it definitely, is it different than the trade we were just looking at? Do I have that other one up here? Where did it go? Losing my mind today. But what I would do with these, you know, because it's an expensive trade, I might sell 4 of these, and if I want that long delta, I'll just buy 5. I'm going to do a 4 by 5 here, and then we'll look at that profit profile. Pretty expensive. But man, it gives you like a wild long delta. So what I'm doing is I'm selling 4 of the 105s and then buying 5 of the 105s in June. So that's 4 May short and then 5 long June, both at the 105. And then you can just direct that wherever you want. You know, there is more risk, but the reward is huge. I mean, we're talking about, you know, that first trade we were looking at, that little, that's not it. That's not it. I'm going to find it here for you so we can compare them. This one. Come on, drag on my screen there. I don't know what's going on. I don't know why I can't go onto that screen. Okay, so there we go. We have them both side by side. Now we can look at these. Okay, this is the 60 delta, 80 delta, and you've got a max profit of $330. And then, you know, if the stock was to sell off completely, it's a $1,250 trade. Well, this one, very, very similar profit 10. There's more contracts, but there's more potential. You can make $1,000 for $2,500 in risk, and this one you can only make $330 for $1,250. So if we were to double this, you can make $660 relative to $2,500. So this setup has a max profit of around $660 per $2,500 in risk. This setup has about $2,500 in risk and has a potential of making $1,000, and no upside risk as well, which is what you're looking for, right? That's the idea. You want to try to make some money from some theta decay, have some long delta, and if Palantir goes crazy, say it goes mental and there's like a short squeeze, this just prints money. So I much prefer this setup rather than those wide spreads. So that's my thoughts on those. Hopefully that helps clear that up. Sorry, that was so fumbly to get there. Okay. This trade is meant to be short, only trying to snipe profits. So you're saying I should go longer. Well, you're just fighting the decay. I mean, it costs more to go longer. It's just one of those things you have to take into consideration as to what where, how much decay are you paying or not. So in these moves, this diagonal, if I just clear these off here, clear myself off, if we look at like a 10% drawdown, the poor man's covered call setup loses $382. This setup loses a lot more. It loses 834. So you've got more downside risk, you're more directionally delta long. So it depends on what you're doing. If you're trying to snipe profits and that's what you're looking for, you want these spikes to be nice and high and have a directional move in your favor. You don't want a trade that takes a long time to play out. So these trades are slow. This trade is relatively fast because it's long directional. So if you're sniping, go for the direction. That's my thoughts on that. And then Mike says, I only chose Palantir as an example. More research would be best used to select the underlying. Yeah, and these setups, absolutely. These don't function over earnings very well. Just so you guys know, I was just on Facebook talking about this this morning because somebody was like setting up calendars and trying to play them over earnings. Well, they don't work very well. Calendars and diagonals actually want IV expansion. They function better when there's IV expansion. They also don't really love being held to expiration. They can be, but oftentimes if you're going to do something, that profit tent kind of grows and then it kind of collapses really quickly. So if the stock is right in the pin, it's fantastic. If you were to look at this trade prior to the day before expiration, the curve would look like that. So it depends on where the stock is. If the stock's at 110, you've made like a decent profit already. If it's at 120, you've made a decent profit. If it's at 130, you've made a decent profit. These are all fantastic. What happens is on that last day, it really starts to conform to this final position. So I like these trades when I want to be long and I want the spike to be below because I know that they grow right up until that day before expiration, and then they really tightly conform to this expiration. On something like Palantir, it doesn't actually even happen until the very last couple of hours, so you can hold it right until the 16th. The other thing that happens is you might be in a position where the stock has drifted down and the shorts are going to expire, and you can just leave that on for one more day and see what happens on Monday. If there's a gap down, then you've profited from both sides. If there's a gap up, you lose some of your profits depending on how the setup is. I did that with gold last week. It was like I had a diagonal. It had failed. It was like basically in the max loss zone. I left the longs open. Gold went up. I had long calls that were just making money, and I was able to recover on that trade, which worked out very well by holding the longs over the weekend rather than closing at expiration. I just let the shorts expire. Do you trade anything in the S-Smith? Do you trade anything in the futures market? Yes, I trade gold and I trade CL. I have a CL trade on right now. That's why I mention these. So when we're looking at these positions, like I trade oil and gold. Both have been great performers for me this year. Oil, seemingly always kind of goes bullish around that 60 level. So there's been a decent entry as of late. My break even on oil is set at around $48. So that's kind of how tight I play it. I won't typically enter until it's in the 60s, and then I play bullish positions with my break even around 48. The gold or oil specifically is tough because when it moves, it can move relatively quickly. So I don't often play with upside risk, and if I do, it's always limited because the price of oil can just rapidly move up. But in the shorter duration or longer duration trades, very, very nice underlying to trade. There's lots of premium in it. So I do trade CL. And then gold, obviously this year, the market started off a little bit tight. I had a couple of losing trades on the beginning of the year in February, March on this little run up right here. And then from there, I've just been long, and it has been fantastic. This is the expectation is it will still be going long. Now, the curve on gold is really sharp right now. So be tentative about this. When I'm looking for entries on gold, what I'm looking for are pullbacks. You know, I'm not trying to get in when it's crazy. I'm very much watching the point of control, which right now is at 29.16. So I don't want to get trapped in a position, and I don't have any long positions on it at this moment with this recent runoff. We're just out of the trades. If not, tell her, can you explain why? Thanks. No, I think futures are a great product. They trade a few more hours, and I just trade gold and silver. But I trade NQ as well, and RUT futures, and yeah, I mean, anything. Why not? Why not trade it? You can, so you can. We can. Mike says, I appreciate your insight. I always overlook ratio spreads for some reason. Yeah, the ratios. Like if I want to, I'm doing a ton to the downside right now. Like on the put side, I'll show you a great little trade. Let me just load it up here. I'm going to pull up. So SPX, you know, let's just look at SPX and where it is. You know, we're in an economy that may not be so great. What is the potential here? Are we going to come back down? There could be a lot of downside here. And with the VIX so elevated, what we can do, I'll just load up the trade here and then I'll screenshot it again. We can put on like a 4 by 5 put ratio spread. And we don't do those with like crazy distance between. But if we go to SPX, let me just load this up. So if you guys are following along at home, load up your SPX chart. And what we're going to do is we're going to look at the index futures and look at next week. So they've got daily expiration. So we'll look at May 16th, which is 10 days away. And what I'm going to do is I'm going to look for a short put that is at a level where I think the market may trade. Now, where do I think the market may trade? What I can do is I can look at this price right now, 56.21, and I can say, well, where might that go? Let me just grab a calculator here, and we'll pull this up and we'll take a look. So we're at 56.21. Now I'm going to times that by 0.95, which gives us about a 5% move. That's that. I'm just going to do that again. 56.21 times 0.95. 533. Wow, why does that seem so far down? 53.39, 53.40. So currently the 53.40 is a 12 delta. That's far too low. I would look at somewhere around the 45.25, which is like 19 delta. So if we were to do that, it's about half the distance. So I'm looking at the 54.25 divided by the current price, which is 56.22. And so it's 96%. So that's factoring a 3.5% downside move to the expiration 10 days from now. And what I would do is I would sell, say, 4 of those contracts. And then I would go out like 30 days. So to May, maybe not even that far. You can just go to like May 20th, 14 days. And then look at the calendar on that. So if I'm selling the 54.25 and then I'm buying the 54.25, I'm going to buy a ratio. So I'm going to sell 4 and buy 5. And what this is going to do is it's going to give me a profit profile. It costs about $6,000. So there's a lot of potential loss there. And I'm just going to screen grab this whole kit and caboodle for you guys, and then we'll take a look at that. And so it's a relatively big trade, but it depends on the size of your account. So there it is. That's what the profit profile that looks like. It has a huge potential. We've got, the stock could make $20,000 if we saw a retracement down to that level. So it's massively short delta. And the break even is right around the current price. So this gives us a short exposure and quite a bit of theta decay. Now, again, we don't have to hold the expiration. If we were to advance this forward and we were to look at what does it look like prior to expiration, let's just go to the first one expires May 16th. Let's look at the May 14th. Yeah, it's not even going to be there. May 15th. May 14th. So I'm going to just pull up the chart for the May 14th. And that's what it looks like. So 2 days prior to expiration, there is profit if the market goes down. So if you're looking for ways to get short, this is a way you can play relatively short duration, very, very tight positions. And if there is a market sell-off to that downside, then these can make a massive amount of money. And it works extremely well. There's no risk of a market crash. So if you're sitting with like a long delta portfolio and you're looking and saying, well, man, if the market went up to 5,700, that would be fantastic. I would make, 50 grand. If your portfolio is going to make 50 grand, if the market went to 5,700, putting this on as a type of hedge would be fantastic addition, because this would mean that you would be giving up $5,000 worth of profits if the market was to go screaming upwards from the 50 that you've already got, that you will be getting from being long delta. And then if it goes down, you have this huge spike to the downside. And IV expansion will completely help this trade. So, these are bigger trades for bigger accounts, but that's the kind of thinking that I'm using when I'm looking at a profit profile. Like if I was to look at my account and the profit profile was such that, most people's account just look like this. It's like a 45-degree line. It's like they make tons of money. They make 50 grand if the market goes up. And if it goes down, they lose 50 grand and they have these whipsaw. Well, this is the type of trade that can take that out and has a massive amount of positive theta decay. This one actually has slightly negative decay doing the May 16th, May 20th, but you could just play with those and go a little bit longer. Like say I did the May 30th, then for the longs, it's going to take me a second to reload that, but you can build these out, and the diagonals with a ratio can work extremely well. Doing the May 16th, May 20th had a negative decay of $69 a day. Doing the May 30th has a positive decay of $150, but it also costs $18,000 compared to $7,000. So it's a bigger trade, bigger positive decay. But if we need directional, that can work very, very well. And I like to trade them like that. And they can be traded on SPY as well. So that exact same setup, I'm just using SPX, but you do it on SPY and it's 1/10 the price. So that $7,000 that I was looking at is now $700, which is completely reasonable for long delta portfolios. And it gives us a profit 10 to the downside. It also means that on days like today, because I trade trades like that, it means that I am getting I have a positive return in my account today, hence the green sign. That's what we're going for. Okay, what else are we looking at? Do you guys have any other questions? We're really beating it up today, aren't we? Mike Mueller beat earnings and the stock collapsed. John Blake, a bit late. Happy Tuesday. Thanks, John. I'm glad you missed my rant at the beginning. I'm going to go chase down Pure Lady. You wouldn't even believe the handwritten sign they gave, or the little tag they gave me too. You can't even read the date as to when my thing is going to be picked up. But luckily, this old splitter is working. It's grinding away under the desk, and it's annoying, but it's actually allowing me to share my screen. Let's do quick 5 minutes. Throw out as many tickers as you can. I'm going to plug them in. We'll look at Seeking Alpha. We're going to look at Investing Pro, and we will take a look at any stocks you guys want. Just type the tickers in the chat room, and then we'll get out of here. So let me just type away. Let's look at, while you guys are typing, I'm going to look at Google. We're going to look at the summary right now. The quant rating on Seeking Alpha is a hold. It's still got this high valuation. Terry Mahoney, can I get your thoughts on a buy right AAL 120 shares May 16th, 1050? You know what? I don't love AAL right now, but you know, I feel like if we are going to see the valuation right now is great. Okay, so it is at a great valuation. There's definitely no surprise there that when the stock is trading at $10.50, that this is a great potential. The problem is, are airlines like the canary in the coal mine? If we do get into like serious recessionary period, are we really getting beat up? And I don't, you know, there's risk to the upside, but I think there's more risk to the downside. So let's look at this May 16th position. When is earnings? They've already announced, right? Yeah, April 24th. So the earnings are passed. So if we did take a look at the options chart for May 16th, and we look at that 1050, we're getting 37 cents, which is a pretty decent premium. So from a quick return on capital, you're looking at about just under 3.5% return on capital in a week, doing that buy right covered call, selling the 1050 and buying 100 shares. That is definitely like it's worth the risk, but we have to be prepared that that stock could be lower as well. So making 3% a week is pretty great. And if there's no exposure whatsoever to a position like AAL, then maybe it might be great to be adding to it. But if some people already have exposure to airlines, and maybe that's not such a good addition at this time. So it depends on what you're doing. But making 3.5% in a week is pretty good. Subsequently, you can get similar return if you did like the 10. You know, there's not going to be a huge amount of difference here. A little bit maybe. 1050. It's trading rate at 1050, isn't it? So you're getting 17 cents. That's about half. But there's more protection on there. Depending on the size of the position, I'd be splitting between the 10 and the 1050, doing that like in the money, and being happy making 1.5% return on the week. Jim says, what would be a good start on SoFi put to start the wheel? Was looking at the $6.25 $12 strike. Yes, I think that level on SoFi, based on where it is right now, the $12. If I was starting the wheel, we want to be lower than the current price. So let me just change this to a different view here. Looking at June 6th, which is a good time frame. The $12 gets us about 50 cents in premium. So that means the break even is going to be $11.50. Let's go to the chart and take a look at SoFi, and then we'll be able to see where that is. So the question always with the wheel is making sure that we're getting into a position that is at a level where we don't mind owning the stock. So $11.50. I'm just going to mark it on here. $11.50 would be the break even. And that is slightly below the 200-day moving average. Now we saw earnings come out and the stock jumped up and now it's retraced back. So is this a good point? I would be pretty happy starting the wheel there for sure. You know, we definitely have lots of potential above. Point of control is still around $16. If we zoom in to this like more recent data, you'll see where the point of control is. It's actually going to be right where it is right now. I thought it would actually be lower with this earnings, but there was obviously lots of volume here after that earnings. So there was lots of buying, and this has retraced. This level being under the 200-day moving average is a great break even. If it goes up, the return is fantastic because the amount of money that we're risking, where are we here? Let's go to the SoFi. The amount of money that is being risked with this $12 strike is $1,150. And the return on that is 34 cents. Sorry, it's higher than that. It's the 12. It's 50 cents. So if it stays above $12, it's 50 cents. So if we go back to my calculator, let's just do that return. We're going to say $50 return. The max loss is $11.50. So on the cash secured balance, It's 4.3%. Now we're dividing that. That's June 6th. And June 6th is, just again, my calculator, 31 days out. So 4.3% divided by 31 days times 365. We're going to get the annualized return. And remember, my calculator does this. My quick options calculator and my rolling options record keeper calculate this annual value based on expiration. So 51% annually, that's a great target. You know, I don't want to target less than that. And I typically want to target about 100% return for short puts. The reason I want to target that is because if I target 100% and I miss substantially and I still make 50%, 20%, that's fantastic. 50% return for a target, a little bit on the light side, but it's also a relatively safe position because we're playing, you know, we're playing far enough out of the money. A more aggressive position, which might be a little bit more return on capital, would be selling that 1250 put. I think that 12 is the right thing. Gives me my break even below the 200 level. That's what I'm looking for when I'm entering a short put. So I like that trade idea. Thank you so much for suggesting it, Jim. That is great. I love those contributions. Okay, you guys are fantastic. I'm gonna get out of here. We are all getting rich together. Would love to chat with you. If you have any questions, send me an email and let me know what is going on, or hit me up in the Discord chat. Thanks so much, everybody. Let's get rich together. Take care.